Now, in the turnover ratio or activity ratio, first ratio we have completed inventory turnover ratio. That next ratio is, after inventory turnover ratio, is our trade receivable turnover ratio. Trade receivable turnover ratio is equal to credit sales upon average trade receivables. Credit sales means credit revenue from operation. Revenue from operation, credit will be taken into account, means credit revenue from operation, that is credit sales, upon average account receivable. Average account receivable means opening debtors and bills receivable plus closing debtors and bills receivable upon 2. So opening debtors means debtors at the first day of the accounting year and bills receivable at the first day of the accounting year. So opening debtors and bills receivable plus closing debtors and bills receivable means at the end of financial year, closing debtors and bills receivable. We will add it, divide it by 2, then you will get the average account receivable. The resultant will be in times. We will express in times. This ratio indicate that this ratio, account receivable, trade receivable turnover ratio, indicate that how effectively or immediately or promptly the credit sale amount is collected. Credit sale amount is collected. As much as it is high, it is better for the business. It means business has collected the amount of credit sales promptly. Otherwise, if it is low, then this will indicate that the business is failed to collect the amount of credit sales from the debtors or from the account receivables. Is not collected by the business promptly, it is delayed. It means credit policy of the business is not good. So this ratio should be, this should be higher. It is better for the company, and if it is lower, then this indicate that company failed to collect the amount of credit sales and it is collected late. So credit sales, as compared to credit sales, we compare the average trade receivable. So average trade receivable should be less and the credit sales should be more. Then only it will be, turnover ratio will be high. Trade receivable turnover ratio will be high. Okay. So this ratio indicate whether the inventory, whether this ratio indicate the relationship between the credit revenue from operation and average trade receivable. Relationship between the credit revenue from operation and average trade receivable during the year. Is it clear? So trade receivable include what? Trade receivable include opening debtors and bills receivable plus closing debtors and bills receivable upon 2. When we divide it, then we will get the average trade receivables. The higher the ratio, the better it is, since it indicates that the amount of trade receivable is being collected more quickly. If it is higher, this indicates that the amount of credit sale is collected by the company more quickly. More quickly. So the more quickly the trade receivable, the less the risk from the bad debts. As early as the trade receivable is collected by the company, the chances of loss in terms of bad debts will be less for the company, and lower the collection expense, and as well as the lower the collection expense. And the lower trade receivable turnover ratio will indicate the inefficient credit sales policy. Inefficient credit sales policy, if it is lower. This indicate what? This indicate that the customer do not deserve much credit. Okay, the customer do not deserve much credit, so we have to slow our credit sales if it is low. Now come to the question. We'll see one question based on trade receivable turnover ratio. We'll see one question based on trade receivable turnover ratio. Okay, so note down the question. The following details From the following details, calculate trade receivable turnover ratio and average collection period. The information are total revenue from operations has given. Total revenue from operation means total sales. Cash revenue from operation, that is cash sales, 20% of total revenue from operation. Cash sales is 20% of total revenue from operations. Revenue from operation return means goods return. Out of credit revenue from operation is 20,000 and trade receivable is given. So the formula, you write the formula first. So credit revenue from operation, we have to find it out. For that, credit revenue from operation is equal to, if you find the credit revenue from operation, credit revenue from operation credit revenue from operation is equal to total revenue okay, total revenue minus total revenue from operation, minus cash sales and minus sales return, then we will get the net credit revenue from operation. So total revenue from operation given is 2,25,000 minus cash sales is 20% of total revenue. Cash sales is 20% of total revenue. Total revenue is 2,25,000. Okay, this is our cash sales minus sales return is revenue from operation return is 20,000. Revenue from operation return means sales return is 20,000. So 2,25,000 minus, it is 1 by 5, it is 45. Okay, minus 20, so 2,25,000 minus 65, 2,25,000 minus 65, 1,80,000, sorry, 1,60,000. 1,60,000 is your credit revenue from operation. Credit revenue from operation is 1,60,000 and average trade receivable, for that the question, in the question it has given opening balance, trade receivable opening balance and trade receivable closing balance. So opening balance is 8,000 plus closing balance 12,000 upon 2. So it is 1,60,000 upon 20 upon 2. So 1,60,000 upon 10,000. So it is 16 times. Answer is in 16 times. 16 times. Okay. Now next is average collection period. Average collection period. Average collection period is equal to number of days in a year, 365. This is the number of days in a year upon trade receivable turnover. Trade receivable turnover ratio. Turnover ratio. Trade receivable turnover ratio. So 365 upon trade receivable turnover is 16. It is 16 times. So 365 upon 16. So you divide it. So it is 73 days. It is 23 days. Coming 23 days. Okay, 365 upon 16. 32, 4, 5, 32, 3, 1, 0, 5, point, 22.5, sorry, it is 8, 22.8. So round off, it is 23. Round off 23. So it is 23 days. These 23 days indicate that the credit sales amount is realized from the debtors within 23 days. So in the balance sheet, the debtors or bills receivable which is reflecting in the balance sheet, that is the 23 days sales. Credit sales is reflecting. 23 days credit sales is reflecting in the balance sheet. Okay, because the credit sale is collected by the company within 23 days. So is it clear? Within 23 days. Okay, within 23 days. So this should be as low as possible, as low. So as much as the trade receivable turnover will be high, instead of 16, if it is 20, then this will be low. As much as low it is beneficial for the company, that company collect the amount in less number of days from the debtors. Now come to the next problem. We'll see the next problem based on trade receivable turnover and average collection period. So calculate the trade receivable turnover ratio and average collection period from the following information. Total revenue is given, that is total sales. Cash revenue from operation being 25% of credit revenue from operation. Cash revenue from operation is, cash sales is 25% of credit sales. It means closing trade receivable is given in the question, and one more information, excess of closing trade receivable over opening trade receivable is 40. So first of all, we'll write the formula of credit revenue, trade receivable turnover ratio, credit revenue from operation upon average trade receivables. Now cash revenue from operation, cash sales is 25% of credit sales. Suppose credit sales is 100. It means cash sales is 25% of credit sales, 25% of credit sales. It means it is 25 is the cash sales. So total sales is 125. This is the total sales, means total revenue. So when total revenue is 125, then credit sales is 100 rupees. So it means credit revenue from operation, we can write it credit revenue from operation is equal to, when total sales is 125, credit sales is 100. So when the total sales is, revenue from operation is 4 lakhs, total revenue from operation is 4 lakhs, then credit sales will be how much? Okay, $3,20,000 is the credit revenue from operation. This has come. We have calculated 3,20,000. Next is closing trade receivable is given in the question, and one more information has given, excess of closing trade receivable over opening trade receivable is 40,000. So closing trade receivable is 40,000 more than the opening trade receivable. So closing trade receivable is, closing trade receivable is given, trade receivable is given, that is closing trade receivable is 1 lakh. It means the opening trade receivable will be, closing trade receivable is more than 40,000 over the opening. Okay, over the opening. It means the opening trade receivable is how much? 60,000 is the opening trade receivable. So opening trade receivable is 60, so closing is 1,40,000 more than the opening closing trade receivable. So 1 lakh is the 60,000 is the opening trade receivable and closing is 1 lakh. So average trade receivable divided by 2. So 3,20,000 upon 1,60,000 upon 2. So 3,20,000 upon 80,000. So it is 4 times. It is 4 times. Trade receivable turnover ratio is, trade receivable turnover ratio is how much? It is 4 times. And average collection period, you have to also calculate the average collection period. So average collection period is equal to 365 days in a year, number of days in a year, upon trade receivable turnover ratio, trade receivable turnover ratio. Okay, so this will be 365 upon turnover ratio is 4 days, 4 times. It is 4 times, so divided by 4. So it is 91.25, so it is 91 days. 91 days, round of figure is 91.25, so we may take as a 91 or 92 days. Okay, it is enter into the next day, so it is 92 days. It is 91 days is completed and 0.5 of the another day, so it is 92 days. So here the trade receivable turnover ratio is very low, so it is not a good symptoms for the company. Company failed to collect the amount within the limited time. So company's credit policy is not good or collection policy is not good. Second indication, you see it is collected in 92 days. Credit sales is collected by the company in 92 days. It means in the balance sheet, debtors and bills receivable which is indicating in the balance sheet is of 92 days. It is too high. It is not a good things for the company. This indicates that the credit policy of the company or the collection policy of the company is not good. Company chances of bad debts will be very high, and collection charges or collection expenses will be also very high, and company will operate with the more working capital. Company need more working capital to operate it. It means cost of capital will also be very high. Now see the another question related to trade receivable turnover ratio. Calculate the trade receivable turnover ratio and average collection period from the following particulars as on 31st March 2020, assuming 365 working days in a year. So total gross revenue from operation is given. Gross revenue from operation means gross sales. Cash sales from operation is given. Revenue from operation return means it's a sales return. Provision for doubtful debts is given. Total debtors as on 31st March 2019, total debtors on 31st March 2020. 19 is the opening, 20 is the closing stock, closing inventory. Similarly, bills receivable 31st March 2019, bills receivable 31st March 2020. Trade payables is this much. Trade payable is not at all related to this calculation of the trade receivable turnover. This is not going to consider. We are not going to utilize this information. Is the useless information while calculating the trade receivable turnover. Which one is trade payables? And second is provision for doubtful debts. Provision for doubtful debts is not, we are not going to deduct while calculating the credit sales. So first of all, we will calculate the credit sales. Credit sales is equal to credit revenue from operation or credit sales. Revenue from operation is equal to, this is also called credit sales, is equal to gross revenue, is it clear? Gross revenue from operation minus cash sales. Cash revenue from operation, this is cash sales revenue. Cash revenue from operation minus your sales return, that is revenue from operation return. We will return, it is what? It is sales return. So gross revenue from operation is 11 lakh. Cash revenue from operation is 1,65,000 and return is 11,000. So 11 lakh minus 1,00,00671, 1,76,000. We'll deduct it. So it is 9,24,000. 9,24,000 is credit revenue from operation. 9,24,000. 9,24,000. The provision for doubtful debts is not going to deduct from here while calculating the credit revenue from operation because it's doubtful. Okay, we'll include on it. We are not going to deduct. Now average trade receivable. In average trade receivable, you see the opening debtors is 55,000 is the opening debtors plus bills receivable, okay, plus closing debtors plus bills receivable upon 2, okay, upon 2. So this is what average trade receivable. So opening debtors and bills receivable, opening debtors is 55 plus bills receivable opening is 11, okay, plus closing debtors and bills receivable, closing debtors is 66 plus 22,000. So opening debtors means debtors on 31st March 2019, closing debtors means debtors on 31st March 2020 divided by 2. So here it is 66,000 plus 88,000 upon 2. 66 plus 88, 1,54,000 upon 2. So it is 77,000. The average trade receivable. So 30 cancel. 11, 7, 2, okay, 1, 2, 12 times. It is 12 times. Okay. Now average collection period is equal to average collection period is equal to number of days 365 upon what? Trade receivable turnover ratio, that is 12 times. 12 times is the trade receivable turnover ratio. So 30.42, it means it is 31 days. 31 days. You write the formula number of days in a year upon average trade receivable turnover ratio, 365 upon trade receivable turnover ratio, that is 12 times. So 365 upon 12. So 31 days. Now come to the next question. Calculate the amount of opening trade receivable and closing trade receivable from the following figures. So here in this question, trade receivable turnover ratio is given, that is 4 times. Trade receivable turnover ratio is already given, that is 4 times. It is 4 times, it is given in the question. Trade receivable turnover ratio. Cost of revenue from operation, that is cost of goods sold, is 6,40,000. Cost of revenue from operation is given. Gross profit ratio is 20%. Closing trade receivable were 20,000 more than that at the beginning. So if the beginning is X, then closing will be X plus 20,000. Cash revenue from operation, 33 and 1/3% of credit revenue from operation. So if the credit revenue from operation, suppose credit, see the last point, credit revenue from operation, if I am assuming it 100, then cash revenue from operation will be revenue from operation, cash revenue from operation as per the last information, that is cash revenue from operation being 33 and 1/3% of credit revenue from operations, then it is 33 and 1/3. So when I add it 133 by this 133 by 1/3, this is your total revenue. You can say it is total revenue. So when the total revenue is this, credit revenue is 100. Credit revenue is 100. Number 1, is it clear? Now number 2, the gross profit ratio is given and cost of revenue from operation is given. So gross profit ratio means gross profit upon net sales into 100. Okay. So cost of revenue, suppose the sales is 100, sales is 100. It means gross profit is 20%. So sales minus GP indicate what? Cost of revenue. It is cost of revenue. So when the cost of revenue is 80, sales is how much? 100. So sales will be, sales means revenue from operation, revenue from operation, total revenue from operation or gross revenue from operation will be 100 upon 80 into cost of revenue from operation, means cost of goods sold has given 6,40,000. When cost of revenue is 80, sales is 100. When cost of revenue is 1, then sales will be 100 upon 80, and when the cost of revenue is 6,40,000, the sales will be how much? So it is 8 lakhs. Sales is 8 lakhs. Okay. And when the sales is 8 lakh, then we will calculate this one, credit revenue from operation. Okay. We can calculate this one, credit revenue from operation. Credit revenue from operation is equal to your relation. Total revenue is 133.33, then credit revenue from operation is 100. So 100 upon 133 upon this. So when the total revenue is 8 lakhs, then what will be the credit revenue from operation? Is it clear? What will be the credit revenue from operation into 8 lakhs? We'll multiply it. So 33 at 3, this is 4 and this is 2 lakhs. It means it is 6 lakhs. 6 lakhs. So credit revenue from operation is 6 lakhs upon average trade receivable. So average trade receivable is equal to trade receivable is equal to 6 lakhs upon cross multiplication 4, 1,50,000 average trade receivable. This calculation is clear because I am going to erase it. Okay, going to erase it because this calculation is over. So step by step you do the calculations and find out the figure. Now average trade receivable is equal to average trade receivable is equal to opening receivable, opening debtors and bills receivable. Okay, we have to find out what? We have to find out the opening trade receivable and closing trade receivable. So opening trade receivable plus closing trade receivable upon 2. So average trade receivable is 1,50,000 upon opening trade receivable if it is X. So as per this information, closing trade receivable were 20,000 more than at the beginning. So opening if is X, then closing is X plus 20,000 upon 2. So cross multiplication, it is 3 lakhs is equal to 2x plus 20,000. Okay, 2x plus 20,000. So 3 lakhs minus 20,000 is equal to, you can write it this side, 2x. Okay, 2x. So x is equal to 2 lakhs 2,80,000 upon 2. So it is 1,40,000. X indicate what? X indicate the opening trade receivable. It is opening trade receivable. Opening trade receivable. So closing trade receivable is equal to closing trade receivable is what? X plus 20,000. X plus 20,000. So X is 1,40,000 plus 20,000. So it is 1,60,000. Closing trade receivable is 1,60,000. Okay. Next, under the turnover ratio is trade payable turnover ratio. Trade payable turnover ratio. So trade payable turnover ratio is equal to credit purchase, net credit purchase upon average trade payables. Trade payables turnover ratio is equal to net credit purchase upon average trade payables. Average trade payables means opening creditors and bills payable plus closing creditors and bills payable upon 2. Payable includes both bills payable and creditors. So opening creditors and bills payable plus closing creditors and bills payable upon 2 is your average trade payables. This will also express in times, and average payment period is equal to number of days in a year, 365 or 366, upon average upon trade payable turnover ratio. Trade payable turnover ratio. This indicate that trade payable turnover ratio indicate that how much amount of credit purchase or credit purchase in terms of creditors and bills payable is in your balance sheet. So this should be, if it is less, then it is good for the company, and if it is more, then it indicates that company's goodwill is not much more in the market. That's why they are not getting the goods on credit. Okay, and where the number of days is concerned, these days should be high. As much high as much high the dates, your average payment period, it is good for the company, because company want to get the credit for a longer period of time. As much as the longer the days is, that is beneficial for the company. So see one question based on it. From the following information, calculate trade receivable turnover ratio, average collection period, trade payable turnover ratio and average payment period. Information are revenue from operation, creditors, bills receivable, bills payable, purchase and debtors. So revenue from operation is given and no other information is given. It means that indicate that it's a credit sale. There is no cash sales. So when you are going to calculate the trade receivable turnover ratio, trade receivable turnover ratio, receivable turnover ratio, turnover ratio, you know the formula, credit revenue from operation upon average trade receivable. So here credit revenue from operation is not given, here it is revenue from operation is given, then we will assume that all sales is a credit sales. So this figure we will take 3 crore 60 lakhs, 3 crore 60 lakhs upon in trade average trade receivable, opening debtors and bills receivable plus closing debtors and bills receivable upon 2. But here the opening debtors and bills receivable is not given, the closing debtors and bills receivable is given, that will be taken into account. This is not going to divide, trade debtors is 40 lakhs and receivable is 8 lakh. This is closing figure, closing debtors and bills receivable. So when closing debtors and bills receivable is given, opening is not given, then we are not going to divide by 2. This itself a average. This will consider itself a average. So 3 crore 60 lakhs upon 48 lakhs. This is, if you divide it 3 crore, so it is 7.5 times, 7.5 times, and average collection period is equal to 365 days upon trade receivable turnover ratio, that is 7.5. So 365 upon 7.5, so it is 49 days. This figure will come in days because it is days and it is in times. Okay. Now next we have to calculate this one, trade payables turnover ratio. Here the purchase is given. Next we have to calculate the trade payable turnover ratio. For that the formula is net credit purchase upon average trade payable. In this question purchase is given. This purchase indicate it's a credit purchase. So net credit purchase is 1 crore 50 lakhs. 1 crore 50 lakhs upon average trade payable, means opening bills payable and creditors plus closing bills payable and creditors upon 2 is called average trade payables. But here opening creditors and bills payable is not given, only one creditors and bills payable is given, so that will be taken into account and that will the average. So creditor is 12 lakhs, and bills payable is given 60,000 is the bills payable. So this will be treated as average. No need to divide by 2 because opening creditors and bills payable is not given. So closing itself the average. So we are not going to divide by 2. So it is 1 crore 50 lakhs upon 12 lakh 60,000. 12 lakh 60,000. So it is In number of days it is 11.9 times. It is in times, expressed in times. And if you come to the average payment period, so 365 days upon trade payable turnover ratio is 11.9. So divided by 365 divided by 11.9, so it is a 31 days. In calculation it comes 31 days. Next ratio under the turnover ratio is working capital turnover ratio. So working capital turnover ratio is equal to net sales, means revenue from operation, upon net working capital. This ratio, revenue from operation upon working capital, this ratio shows that as much as it is high, it is good for the company, which indicate that the working capital is utilized by the company very efficiently. Okay, working capital is utilized, it is much faster in rotations. Working capital is faster in rotation, and this is good for the business. And as low, if it is low, then it is not good for the business. It means the company is not in a position to use the working capital properly. Okay, not able to use the working capital. Rotation of the working capital is slow. And if the rotation of working capital is slow, this type of company need more capital to operate the business. Okay, and if the working capital turnover ratio is high, this indicate that the company efficiently utilizing his working capital and rotating his working capital very fast, and this type of company use the less capital and give the better result of the turnover. Now see one question based on that, working capital turnover ratio. Working capital turnover ratio, you have to calculate from the following information. Cash revenue from operation is given, credit revenue from operation is given, revenue from operation return means sales return, liquid assets, current liabilities and inventories. So revenue from operations is equal to, in this question, if you see the revenue from operation, so revenue from operation is equal to cash sales. One information is given, cash revenue from operation. Cash revenue means cash sales plus credit revenue from operation. Cash revenue from operations plus credit revenue from operation plus credit revenue from operation. Credit revenue from operation means credit sales. Credit revenue from operation minus sales return. Minus sales return is revenue from operation returns minus sales return. This is what it is, sales return. So cash revenue from operation is, cash revenue is 1,30,000 and credit revenue from operation is 3,80,000 and return from revenue from operation is 10,000. So it is for 5,10,000 minus 10,000, so it is 5 lakhs. So 5 lakh is the revenue from operation. 5 lakhs is the revenue from operation. Now we have to know the working capital. For that, the liquid assets, current liability and inventory has given. Liquid assets, current liability and inventory. You know the formula of working capital. Working capital is equal to current assets minus current liability. Current assets minus current liability. Okay, and current assets is equal to liquid assets plus inventory. Okay, plus inventory. So liquid assets is given in the question. Liquid assets is how much? You see the liquid assets given in the question is 1,40,000 and inventory is also given 90,000. So current assets is 2,30,000 is the current assets. Now coming to this point, working capital is mentioned in the question. Working capital is given? No. But current assets is 2,30,000 is here and current liability given is 1,05,000. So working capital is how much? Working capital is 1,25,000 is the working capital. 1,25,000 is the working capital. You write the working capital over here and calculate in times. So it is 4 times. It is 4 times. Now see the next question. Revenue from operation, calculate revenue from operation, that is sales, cost of revenue from operation, working capital and current assets. You have to calculate the 4. From the information given below, trade receivable turnover 4 times, current liability 5,000, average debtors 1,80,000, working capital turnover 8 times, cash revenue from operation 25% of revenue from operations and gross profit ratio 33 and 1/3%. So trade receivable turnover ratio, if you write the formula of trade receivable turnover ratio is equal to trade receivable turnover ratio is equal to credit revenue from operation upon average trade receivable. Okay, average trade receivable. So trade receivable turnover ratio is given, that is 4 times. It is given in the question, and the average debtor is also given. That is 1,80,000 is the average debtor. Average debtors means average trade receivable. So credit revenue from operation, we can find it out. Revenue from operation. Okay, so we'll cross multiply this. So credit revenue from operation, revenue from operation is equal to 1,80,000 into 4. So it is 7,20,000. 7,20,000. Is it clear? 7,20,000. Next you see, next information is cash revenue from operation is 25% of revenue from operation. Suppose revenue from operation is revenue from operation is 100. So on here cash revenue from operation is cash revenue from operation is, on the basis of that, it is 25% of this, 25%. It means 75% is credit revenue from operation. So when the credit revenue from operation is 75, so revenue from operation is how much? 100. So we can calculate the revenue from operation is equal to, when credit revenue is 75, revenue from operation is 100, so 100 upon 75, and credit revenue from operation is 7,20,000, then what will be the revenue from operation? So it is 4,3 so 0,000 9,60,000 is revenue from operation, 9,60,000. Next you see gross profit ratio is 25%, 33 and 1/3% is the gross profit ratio is how much? 33 and 1/3 percentage. And another information is given, working capital turnover ratio. Working capital turnover ratio is 8 times. And revenue from operation we have calculated 9,60,000. So the working capital is equal to 9,60,000 upon 8. So 1,20,000 is your working capital. So we have find out what are the things we have find out? Working capital, revenue from operations, and now we have to find out this. First information is this, okay, first one is this, we have find out number 1, number 2. Now number 3 is working capital. Number 2, find cost of revenue from operation. Number 2, cost of revenue from operation. Now we'll find out the cost of revenue from operation. Is it clear? Cost of revenue from operation. Gross profit is how much? Gross profit is 33 and 1/3%. So if the sales is 100, GP is 33 and 1/3. So when I deduct, so it is 66 2/3. Okay, it is what? It is credit sales. It is what? It is credit, not credit sale, it is cost of goods sold. So when the sales is 100, cost of goods sold is how much? This much. So when the sales is 100, cost of goods sold is this. When the sales is 1, then this will be this. And when the sales is 9,60,000, okay, then what will be the cost of revenue? Cost of revenue is equal to, cost of revenue is equal to this. Okay, so 33, 3, it is 2, so it is 6,40,000. Cost of revenue is 6,40,000. I correlate with this and put the formula over here on the basis of that. So it is 6,40,000. Now we have to find out the current assets. We have to find out the current assets. So this is the information number 3. This is information number 2. So 1, 2, 3 we have find it out. Okay, now come to the next, fourth one. We have to find out the current assets. So working capital is equal to current assets minus current liability. Working capital is 1,20,000. Now in this question, current liability is given 5,000 is the current liability. So current assets is equal to 1,20,000 plus 5. So 1,25,000 is your current assets. 1,25,000 is your current asset. This is the fourth one. Fourth. Okay.